A ruined credit score rarely happens overnight. Most damage comes from small, quiet habits stacking up every month until a major loan is denied or your interest rate spikes. Today, we will walk through a real-time 7-step audit to identify the specific habits draining your score and apply the adjustments that fix them. To follow along and make these changes right now, open your primary bank or credit card app and grab a notepad. Keep in mind, this is general education, not financial, tax, or legal advice. Bigger decisions deserve qualified professional guidance. Identifying and sealing these daily leaks reduces the hidden costs of borrowing. This shift in behavior moves the pricing power away from the lender and back to you. Step 1 is the Utilization Fix. Inside your digital banking interface, locate the date labeled Statement Closing Date. This split screen shows the difference between your payment due date and your statement closing date. The closing date is when your bank reports your balance to the credit bureaus. Scoring models evaluate that exact snapshot, regardless of when your payment is actually due. If your card limit is $2,000 and you carry a $1,200 balance when that statement closes, you are utilizing 60% of your available credit. Even if you pay it off on time a week later, that high reported balance causes risk algorithms to flag your account. The fix is to schedule your payoff 2 to 3 days before the statement closes. This ensures a low balance is the only thing the bureaus ever see. Step 2 is the Autopay Failsafe. A single late payment hits your score aggressively. Even a forgotten $35 bill can cause lenders to reprice your future loans at a much higher rate. You need to eliminate human error. Go into your settings and lock the Autopay minimum balance switch to the on position for every active account. Mastering payment timing and automation ensures the algorithms classify your behavior as stable, which helps prevent artificially inflated interest rates. Step 3 is the history lock. Closing old, unused credit cards might feel like cleaning up your finances, but it can often lower your score. Identify your oldest open credit card. Keep it active by attaching a single, automated subscription to it, ensuring the account remains part of your profile. This timeline illustrates your account age. Scoring models reward a long, unbroken track record because it provides more data points for your reliability. If you close that oldest account, you shorten your history and shrink your total available credit. The models interpret this sudden change as an increase in risk. Step 4 is the application freeze. Retailers often offer a one-time discount to get you to sign up for a store card at the register. When you apply, the lender performs a hard inquiry. Applying for several cards in a short window signals to risk models that you may be under financial stress. The warning tone. If the primary account holder carries a high balance or misses a payment, that data appears on your report and drags your score down with them, even if you never used the card. Step 7 is the collection sweep. Look at the Collections tab for old, small utility or medical bills that you may have overlooked. Ignoring micro-collections because the amount feels small is a significant error in judgment. A $90 utility bill left in collections can cause a drop in points that takes months of disciplined payments to recover. Aggressively auditing and scrubbing these anomalies ensures that your financial profile reflects your actual behavior, not the mistakes of others. If you followed these steps, your utilization is now optimized, your history is protected, and you have a routine for monitoring errors. A high credit score acts as a defensive shield. It prevents lenders from charging you the higher interest rates that siphon away your income. Which of these habits affected your score most before this audit? High balances, missed payments, or report errors? Let us know in the comments. Maintaining these small habits protects your access to capital and keeps more of your income in your own pocket. Subscribe for more ways to manage the details that matter.